I normally don't talk about my holdings here on YouTube, but I do enjoy helping investors to learn from my own mistakes instead of you costing yourself a lot of money, a lot of pain, a lot of time to learn from the same mistakes that I actually did. This is very, very important. This is why I try to read a lot of books, because I can learn from other people's mistakes instead of myself losing money to learn the hard way. But most of us as human beings, we tend to not listen. We don't find it interesting. We're like, yeah, whatever. I know better than this person. And then you make the same mistake I made, and then you learn the hard way. So I don't want this happening to a lot of people, which is why I try to do these videos, even though they don't get a lot of views. And I decided to do one today to talk about my best performer of 2023. It was a combination of many years of mistakes that I learned from them, and I implemented all of them into one single trade, and it's been extremely successful so far. And then later on, I'm gonna do another video talking about my worst performer year to date, and maybe something I did wrong, or what kind of mistakes I can learn and you could learn from them, and lessons and many other things. Now, I really hope you enjoy this one. I hope you watch the entire thing, because there's a lot of things to learn. I mean, it's one of my best and most important videos in my personal opinion. Now, before you get into the video, I actually made a video last month talking about my microcap investment strategy, because I recently started investing in microcaps in early 2023. It only got, pretty much 2,200 views. I was expecting much, much more, because it was a ton of free content. I mean, a lot of things I learned from this book, 100 to 1 in the Market. So you could maybe, consider watching it. But the first pretty much stock and my best performer year to date, it's not an AI stock. You might believe, oh, it's up 150%, so it has to be an AI stock. It's not an AI stock. It's not a technology company. It's not a pharmaceutical company. It's not anything like you might imagine, some biopharmaceutical or gold mining stock or something. It's none of that stuff. It's actually a food company that makes meatballs. And it's pretty simple. The company is MAMA Mama, which is Mama's creation. The name before was Mama Mancini's. They are, known for the Mama Mancini's meatballs. I bought the stock at $1.74, and now it's sitting at $4.40, and I'm up around 152% year to date. Now, I'm going to tell you a little bit about the stock, because I still believe it has a lot of upside potential in the future. And this is a small company right now. It's only 150 million market cap. So none of this is financial advice. When I bought it, it was like 60 million or 58 million market cap. It was very, very small. And I tend to focus on that stuff in my own investment group. I have 3 more. They are like 50 million, 60 million. One of them is like 29 million. I mean, the float is very, very tight, but I tend to keep them in small position. But like this one, it just grew into a much larger position than I was expecting. So the first mistake that I made before, and this is a mistake that most of us make, especially if you're a value investor, is you pretty much never buy a stock at all-time high or a 52-week high. You just cannot do it because you believe you're late to the party. Well, in the case of MAMA, which is Mama Mancini's, I bought it pretty much at the 52-week high. I originally bought it around $1.88, $1.90. It was already run up like 80%. So normally before, in my previous years, I look at that stuff, oh, it went up 80%. So therefore, I'm late to the party, I don't buy it. And then after it goes up 80%, then it goes up like 200-300% more. But this time I learned my lesson. I did not care about how much the stock was up. I was looking at the fundamentals. In case of this company, a new CEO came along and he transformed the company. So the move was actually justified by the fundamentals, which is why I bought it at 52-week high. But this is something, especially if you're a value investor, you tend to have something in your head where you just want to buy, the worst stocks, the worst charts, the 52-week low, and I still do that stuff. But I learned sometimes to stop paying attention to the 52-week high and focus a little bit more on the fundamentals. This is a very valuable lesson. I made a lot of mistakes, lost a lot of money, missed a lot on upside, just because I didn't buy 52-week highs, but I learned from it and I actually implemented it here in the stock. The second lesson that I learned, this is another one that I learned the hard way, was buying a stock and just selling it because it went up, trying to trim it, trying to take profits. For example, if I was 2 or 3 years ago and I bought a stock like Mama Mancini's and it went up something like 20 or 30% in 2 or 3 weeks, I would have sold it because I want to take profits. Why? Because the stock is overvalued. Well, if I did that with Mama Mancini's right now, I would have missed on at least 100%, 120% worth of gains. This is another one I learned the hard way. Don't sell a stock just because it's overvalued. This is a very important one because you have to look at the fundamentals. The stock might be overvalued, but if the fundamentals are improving, And it's ultimately going to grow into the valuation. It might take a year or two, but it's ultimately going to grow into it. Most of the best performing stocks ever, like Visa, MasterCard, Waste Management, Apple, they pretty much always stick at 52-week high. They mostly look overvalued, but you just keep getting more overvalued. This is because the market is rewarding them for the amazing execution of the company and of the management team. So you have to pay attention to the fundamentals. So yes, the stock might be overvalued. Now it's overvalued. It's trading like 23 or 24 times earnings. But it was also trading at 24 times earnings 3 or 4 months ago, and it was trading around $3, much lower than right now, but the company grew into the valuation. It is growing into the valuation. So unless something like Mama gets to 40 or 50 times earnings, I'm not going to sell it at 20 times earnings just because the stock is overvalued or just because I want to take profits. Don't focus on the price for you to know if you should take profits. Focus on the fundamentals. Unless the stock goes from 10 times earnings to 50 times earnings, then yes, maybe you could take profits because there's no way the fundamentals can catch up to the share price. But if the company is still growing, if the future is intact, if the next 5 or 10 years are still intact, and they are, I'm going to show you with the stock, why would I sell it just because it's overvalued? This is a very important lesson. But the company, it's pretty attractive. And the main reason I found it very attractive, and the main reason I bought it and the main strategies that I implement with my micro-cap investment strategy is I look for high insider ownership because I want the management to have skin in the game. Because the companies are very, very small, I want them to have skin in the game so their own incentives are aligned with my own incentives. And in case of Mama Mancini's, the insider's holding is 24.3%. So that's pretty much a quarter of the company is owned by the management and the insider. This gave me a lot of safety to invest in the company. And they have distribution partnerships in many different, popular retailers, Publix, Whole Foods, Sam's Club, BJ's, Costco, Aldi's, ShopRite, Fresh Market, QVC, which is a pretty popular one for them, and many other, Albertson and many other places. It's a pretty well-known brand in terms of meatballs and stuff, but they have been diversifying lately. They did a lot of acquisitions. So now they don't only have meatballs, they have salads, they have pastas, they have olives, sandwiches, soup, pizza, and they're still doing some acquisitions. Like they want to acquire some sushi company and many other things. And this is very, very important for the company. They are pretty popular with the meatball stuff. It has a pretty interesting story. A lot of people will say, hey, it has no moat. But if you try to taste it, and I tried the product, it was just amazing. I never tasted anything like this. I would highly encourage you to, do it. And if you look at the margins, and this is why I originally bought into the company, there was a new CEO that came along. In pretty much a few months, he increased the gross margins from 11.9% to 30.3%. Massive, massive expansion because the previous manager were just absolutely stupid. For example, they have 2 different products to the same store. In the same day, 2 trucks on different times are coming along. So the CEO said, this doesn't make sense. So what he did, he just put all the products within one truck, he saved on logistics and shipping and just ship it all together. And then he started promoting other products. This is why I talked about this expansion, which is very, very important. Other retailers that carry the meatballs, they say, oh, you also have salad, or you also have pasta, or you also have olives. So then I get all that stuff within one truck shipped to one specific retailer, and they are saving a lot on costs. They also increased prices. They were late on price increases. They did increase prices. It was pretty amazing. And this is what the CEO is focused on. You could watch one of his videos, pretty amazing. He said, our top priority is margin, and then margin. And he has a saying that says, what gets measured gets improved, meaning he measures every single penny, everything, and he just tries to improve it. It's just an amazing CEO. I felt very comfortable investing in the company because of the CEO. He came from Mondelez. He was in the acquisition team over there. Pretty amazing CEO. You could, go and watch one of his videos. Pretty amazing stuff. The company is still innovating. They have a recent innovation. It's called Meatballs in a Cup. And this is their expansion into convenience stores, because a lot of convenience stores like 7-Eleven, and many other, Circle K and many others, they told them, we love our meatball stuff, but we just cannot put it in the store. So they created something called meatballs in a cup for them on a to-go kind of meal. You could just put it in the microwave and then you could just eat it up. And so far it has been successful. So there's a lot of different growth areas within the company that the CEO is actually focused on. But the main goal of the CEO, and this is his vision and this is his plan, is to become a $1 billion company by 2030 in terms of sales. So $1 billion daily solution provider by 2030. And he did many interviews, and he said so far he's in front of his plans. He is way ahead of his original plans. It exceeded his expectation. And this is only 2030. So this is 7 years from now. But he said he's going to get there in terms of growth and in terms of acquisitions. And you could see the strong revenue growth. It has been increasing a lot, especially since the CEO joined. He did a few acquisitions. I mean, it's only 93 million. Again, it's nothing. His goal is $1 billion by 2030. And if you watch the executions of the CEO, you watch everything. I mean, it's pretty amazing. But even if they achieve half of that, there's still a lot of upside potential on the stock, which is why I'm not selling it, which is why I'm still invested in the company. And this is how I think about it in general. The latest net income margins are 7%. Now, last year, the company was unprofitable. This is how much the CEO changed stuff. It was losing money, and now the net income margins are 7%. And he said we're nowhere close to our potential. They could be 10% or more over the long term. And this is what I'm looking for. So the way I think about it is I'm looking at his goal, which is something like $1 billion in sales by 2030. Now, if we take a 10% net income margin, this is around $100 million in revenue, in net income. We take the $100 million in net income. Food companies normally trade 15, 17 times earnings, or 13 or 12. So I'm putting in $100 million of net income, 15 times earnings. This is something like $1.5 billion in market cap in 7 years. The company is still trading 150 million market cap even after it's up so much. So if it's trading at 150 million, and I believe it could be worth $1.5 billion, this is still over a 10x from here. Over the next 7 to 10 years with a very boring food company, necessity stuff, the trend is with them. A lot of people with inflation, they're not eating out, they don't want to go and eat out, put all the gas money, put all the tips and all that kind of stuff. They want some high quality meal to prepare at home. Mama Mancini's is filling in the void. They're doing a lot of stuff, a lot of acquisitions. They hiked prices. People are still taking it. You could look at the recent quarters. It has been absolutely stellar revenue growth, stellar profitability growth, pretty amazing stuff. So I still believe there's over a 10x on the company over the next 7 to 10 years if the CEO executes on his 2030 vision of $1 billion. But even if he's 50% wrong, this is like a 5x from here over the next 7 to 10 years, and I'm already up 152%, so I'm sitting in a pretty good position. This is how I think about the company. This is one of my investments. I learned it the hard way in a lot of different ways, and I took everything that I made, all the mistakes that I made, and I put them all in this one single trade, and it's been extremely successful for me. Now, my other investments, some of them are flat, some of them are down in terms of micro caps and stuff, but if you're patient, if you have a few year horizon, because a lot of people joined like 4 months ago when I bought the stock, they looked at my micro cap stock like, yeah, whatever, and they quit. Well, they didn't even buy it, they even look at it, they even read any of the research that I did, and I missed over 150% on the upside in 4 or 5 months. So if you're not someone that's lazy, if you're someone that has a long-term horizon, you'd like to join me in finding more of those potential opportunities. We own 4 or 5 of them, maybe 3 of them go to zero. If 2 of them goes up 100 times or 10 times, we're still doing pretty well in the micro cap investment strategy within my overall portfolio. So if you're interested in that stuff, you could consider joining my own Discord. The link is in the description. But I hope you learned something from this video. Mainly, don't look at 52-week highs and be anchored on them. Don't be, scared to average up. I did average up on the company a little bit once it started moving. Look for high insider ownership. Don't just, if your friend asks you for a stock, what do you think about it? Look into it. Maybe you're missing on the next Tesla or the next Nvidia. You never know. So it's best to look into it so you have no regrets that you at least was not lazy and you looked into something and you tried. So this was my main takeaway from here. And this was my best performing investment year to date. And the next video is going to be my worst performing investment year to date and the things I learned from it and the mistakes. So I hope you enjoyed that stuff. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.